Meanwhile, back in the U.S. with the Fed's September policy meeting less than a month away, Federal Reserve watchers are wondering if the economy is healthy enough to withstand higher interest rates. Here's what former Federal Reserve Chairman Alan Greenspan told our own Trish Regan yesterday.
It's extraordinarily sluggish. It's fundamentally being suppressed by a very low rate of increase in productivity, in fact, close to zero. And you can't get more than a 2% growth rate out of those numbers.
And joining me now is Laffer Associates founder and chairman and former Reagan economic advisor, Art Laffer. Art, great to see you as always. Thanks so much for joining us.
Thank you, Marie. You guys have been having a lot of fun on this show this morning.
Yeah, we're having a lot of fun.
I'm embarrassed watching you, but I loved it.
I'm so glad. I'm so glad. Well, we're not exactly celebrating a growth story in the U.S. Do you agree with Greenspan that this economy is quite sluggish?
It's horrible. There's been no recovery at all, literally, since the Great Recession. Now, we haven't fallen any further. But whether you look at employment or GNP or any of the numbers there, he's completely correct. It's in just really sluggish and really no recovery. And we can't keep on like this and keep prosperity in America.
What does that mean for the Fed in September? Do you expect the Fed to raise rates because they want to get away from the zero policy?
Let me tell you what they would like to do. They would like to keep rates low if they could. But they are facing a lot of opposition. Obviously, the low interest rates have not worked. They haven't worked at all. What they have done, by the way, with low rates, Maria, is they've suppressed mortgage capital money from coming into the marketplace to fund housing starts and new investments. So by keeping rates low, I believe they have really precipitated the problem in the housing market and in the capital markets. But they believe that lower rates will stimulate the economy, and they believe that lower rates are an insurance against the economy falling further. So they would like to not do it, but I don't know what the political pressures are on them to do it.
But it's Charlie Gasparino here. How are you?
Hey, Charlie. How are you? Very well, Charlie. I loved your comments.
Well, we won't get into some of them, but in any event, we won't ask you about Ashley Madison. But in any event, hasn't China essentially devaluing its dollar, devaluing the yuan, whatever it's called, its currency, haven't they essentially raised rates for us?
Well, yes, they have. But let me do China a little bit. And I think a lot of people miss this part of the story. The dollar over the past year has appreciated by 22% relative to all currencies. China has pegged the yuan to the dollar during that whole year.
I got the
Chinese
currency right. Thank you.
Has also appreciated as well. So when you have an appreciating currency, you always have lower interest rates and lower inflation. Now that China is unhooked from the dollar, you would expect their inflation numbers and their interest rate numbers to rise. And that would alleviate some of the pressure on the U.S. That's true. But the U.S. has had a very strong dollar, and that comes with low interest rates and low inflation.
Now, Art, when you look at this morning's world news, you have, never mind Charlie's Chinese yuan, but the Vietnam's dong. The ding dong was basically devalued this morning. You have the Indian rupee is now under pressure. So the Indians are saying we can't really cut interest rates with our rupee at 2-year lows versus the dollar. What do you think Fed policy looks like in this world where all of a sudden Janet Yellen, and I can't find it for the life of me in the Federal Reserve 1913 Act, where we have to deal with the rest of the world's burning currency issues?
I don't think we do have to deal with the rest of the world's burning currency issues. And in fact, if you go back to the 70s, you can see where countries literally had very different monetary policies. Look at Switzerland back in the 70s, had low interest rates, strong currency, and they were able to run it separately. The U.S. should, in fact, look at monetary policy with respect to the United States and the United States alone. Now, with China delinking from the dollar, China is going to have a very different monetary policy future than we are.
Now, that was the Reagan, you got this, but you do remember, obviously, by 1985, you absolutely murdered emerging markets by taking care of your own house. You'd be good with that.
Yeah, well, let me just say that when we came into power in office in 1981, the dollar appreciated from 78 to 81. I think it doubled in value. Huge, strong dollar. Interest rates fell sharply. Inflation dropped off dramatically. That is the process which was happening right now in the U.S. Now, we don't have the strength of the economy. We increased the demand for money by tax cuts and by sound monetary policy. These people are not doing that.
But isn't that the problem with the Obamonomics? Like, it's a one-trick pony. It's interest rates because the rest of it is
that trick.
The rest of it, right? But the rest of it
is
not
even his policy. That's the Fed policy. So it's like no policy.
But
and
the
rest
of it
is oppressive.
It's oppressive. It's destimulative.
Right.
I mean, so
it's awful. that we are discouraging people from coming into the capital markets and lending money. Who wants to lend mortgage money 30 years at 3.5%? That's crazy. So there is no mortgage money coming in.
What would be the most important fiscal policy? Put monetary policy and the Federal Reserve aside for a second. What would be the most important fiscal policy, you think, to come out of this to come out of government, and maybe it's probably the next president, to actually move the needle on growth in the U.S. economy? What's most important?
The easiest tool for fiscal policy is tax rate changes. And I think we can really do a lot of things to start picking that low-hanging fruit and getting this economy going. Hillary has got the exact wrong message. Not only should you not have higher capital gains tax rates, but you also shouldn't have them decline over long periods of time, because that locks capital in and doesn't allow it to go to its best uses.
And complicate an already super complicated tax code.
It is
just
terrifying.
Capital gains taxes is ludicrous. What she's trying to do.
It is ludicrous. It's truly ludicrous.
Art, doesn't it make your head spin that Hillary's listening to Bernie Sanders more than her husband? And here's the interesting thing: you supported President.
That's the sickest thing ever.
You supported President Clinton. You thought that he had it right on capital gains.
He did.
What's going on?
He had it right on so many things. I don't know what's wrong with the Democratic Party, but they've sure as hell have left all the Clinton stuff and all the Kennedy stuff. They no longer are the party of growth, and there's no reason why. The Democratic Party cannot be the party of growth. I did Jerry Brown's flat tax in 1992, which was the first serious presidential candidate to propose eliminating progressivity in the income tax. And we went from 8th in the race to 2nd in the race. In fact, I think Jerry would have won the nomination against Bill Clinton if he hadn't said that he was going to have Jesse Jackson as his running mate coming into the New York primary.
Well, look at him now.
Look at him now. It's an exact. But that just shows you what politicians are. I mean, really, politicians are a group of people who had bad mommies.
Art,
these are people who don't know right from wrong. They just follow the cord.
Art, you are masterful. We appreciate your time. Thank you so much.
You guys are wonderful. I really am jealous of not being there in person.
Next time we expect you on set, Art.
You got to hear what's on the brakes, Art.
Art Laffer joining us there. By the way,